All right, we are back once again with Lyle Stein, and we're going to continue the conversation about the European markets, France's debt concerns. Lyle, thanks for joining us today. And let's continue the conversation. We were talking about France and the concerns over the debt they are carrying there.
Yeah, exactly. And it leads into that whole notion of an insurance policy against geopolitical concerns. So let's just going back to France. We don't need to rewind here. Basically, France has a revenue problem. They just don't have enough revenue to deal with their spending. And you need a majority government to make those tough decisions to get around that. So for the time being, until they actually have a majority government that can step in and cut spending, because it's hard to raise revenue, as they've discovered over the years, there's going to be some issues. Same thing has percolated over across the English Channel to the UK. They have to cut spending. They need to raise revenues to balance their budget to make the bondholders happy. And the biggest fear in the capital markets that we see out there, I mean, when you look at what's a doomsday scenario, is you wake up and somebody decides they don't want to buy a government bond issue anywhere in the world. And that even goes over to Japan, where their central bank is talking about dropping rates, keeping rates low, and then take it to the U.S., the biggest bond market in the world. You've got President Trump saying interest rates are too high. You drop rates, the cost of money goes down. Holding gold becomes better. It's that debasement trade. And then you look at the developing market, and they too want to have gold in their portfolios. But all this risk is now coming to the fore in a way it hasn't. And again, France could be the catalyst to something much bigger in the context of that bond market meltdown.
Could we see something like Greece or even worse than that?
It's hard to forecast that. But yes, possibly you can, because they may require a European Central Bank bailout. And what does that mean for a country where, I spoke to someone yesterday where, the people like to protest when they don't get their way. And so there could be some tear gas in the streets kind of thing as politicians have to implement. Is it going to be a major default or a default risk? It's hard to predict. Italy got through. The biggest concern after Greece was what's happening in Italy. And politically, they have tightened things. And Italy has now become, like I said, a cheaper bond on a spread basis than France.
And you mentioned is Canada looking at something like that too? Are we getting close to that precipice?
Well, I don't think we're quite there on a national level. People talk about the federal debt. We have a $60 billion deficit forecast for the year that I think we just finished, compared to 45 originally. We're not there. But the bigger issue in Canada will be provincial debt issues. And we allow our provinces to borrow, unlike the U.S., where states and really can't do that. If there's going to be a problem, it's going to come out of the provinces' potential inability to raise money, because the market is concerned about provincial revenues relative to provincial expenditures. I wouldn't put us anywhere near what's going on in Europe or the UK.
And as an investor, what do you do with all this then, when you're looking at those numbers?
The question is how much bond exposure do you want to have in your portfolio? We are very light. We have, like every investment manager, we have ranges that we have client guidelines for debt in, and we're at the lower end of the range. And so why do you own fixed income? You own it for the interest, the stability of the payments from that, as well as the fact that you get your money back first if things really get bad. The reality to us is that the compensation, those interest rates, aren't quite there. So what we've held in client portfolios has been preferred shares. And we also have just bought some shorter-term U.S. debt, maturity of about 2 years, as well as the first time since the pandemic, inflation index bonds, again, just as a little bit of an insurance policy against central banks letting the monetary lever go to full speed.
And then we bring gold back into this, don't we?
And all things actually wind up to gold in this kind of period where the battle that central banks, and more importantly, the battle that central governments are looking at, is one of near-term deflation. I'm not talking prices going negative, but slowing economies, which could ultimately lead to a deflationary scenario. Central banks don't want that. Politicians don't want that. The solution in the near term is to inflate before you suffer deflation.